Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. G'day, mate. How you going?
Good day, mate. I am actually excellent. I've got a haircut.
You look great. Yeah, you look
Thank
really
you.
Good. How'd you
That's
do
my
that?
it's my new acquired skill. I call it the pandemic skills. And after many bad haircuts, what I figured is that you can go from number 6 to number 4 to number 2. That's my hot tip of the day. It's not a stock tip. If you want a haircut, you start with the number 6. Then you take off a little bit, you take off a little bit more, and then you can finally do the fine, the fine grain touches to the sides. So I thought I did a good job. My wife was not completely unhappy, which basically means that it was not that bad.
How did you do the back of your head? I find that's pretty tricky.
I would do the same thing. Just I used the trimmer all through, and then basically just used, number 6 and then number 4 and then number 2 at the edges, and then used my shaving razor to fix as much as I can. Yeah, the back. So the back is not, what you'd get at a barbershop, but
you don't have to see it anyway. So what does that matter?
Exactly. It doesn't matter. This is my new skill. I have another potential employment. I can have a barbershop.
You could, yeah. There's low barriers to entry. And if prices are anything to go by, good margins. So
good margins too.
Yeah. As long as maybe if you can double it up as a barista, you might be able to offer them a coffee and there's a treat,
So just buy an espresso machine.
Cross sell.
Cross sell. I'll do that.
All margins, ARPU, it's going up.
ARPU.
Great, mate.
Yeah.
I like it. So let's just let's get into the talking points. We don't have as much to talk about because it is actually the end of reporting season now here in Australia, at least. And before we get to some of the things that we want to talk about, though, we should talk about how can people find us? How can people reach out to you on Twitter?
Well, let's start with, how people should reach out to you on Twitter. They should go to @Owen Rask, yep. And send all the questions over that they want us to answer. Sometimes we answer them actually live on Twitter. We don't mind doing that. Have a little fun, but yeah, that's how you reach Owen. You can reach me at 7A Mahanti. And Twitter is a lot of fun. Some people don't want to be on Twitter. Twitter is a good spot to learn stuff, right? If you want to learn, and you can stay away from the politics and stay away from the negativity if you want. And if you want to have a good fight, maybe you can get into the negativity too. It can be very entertaining as well. And you could philosophically debate and stuff like that. So I encourage people to get onto Twitter. I do not own Twitter shares, so this is not about pumping my stock.
I did own Twitter shares for a long time and it worked out okay, actually. But I looked at it the other day and it really hasn't gone anywhere in the last few years. So thankfully I sold that. Would have been better off buying Square, mind you, the whole time. So
that's true. I actually did own it as well, like you. And one day I realized that the only reason the stock price doesn't go up, despite good results, is that they keep diluting. So their share-based comp was so fast and so quick that the share count kept going up. So yeah, and eventually I basically gave up on it.
Yeah, they pay themselves pretty well in some respects. So that's okay. We've got some companies today to talk about that we think align pretty well with investors, and we're going to share our key companies from reporting season, being global and ASX. So there's plenty on offer today. Mate, always good to ask you, though, at the start of the show, what have you been working on at 7 Investing? Anything in particular? Other than teaching everyone how to do haircuts.
Oh, heck, this is my new thing, teaching people how to do haircuts. Mm-hmm. But other than that, I've been working through my watch list. And every month, I find this very, I don't know about, maybe you can tell me how you feel about this, but when I have to pick a stock, people might think, well, you ask a stock picker to pick a stock, should be easy. But I find, like, until I lock in my stock, I find that process very agonizing. And I still find it agonizing because I have a list of, I could go to and look at my portfolio and say, okay, I'm going to pick this one. I have a watch list. I can pick, but just the process of narrowing it down, I find it hard. I still find it very hard because I have a variation of companies. This time, like, I think I'm down to maybe 4 or 5, maybe. And, I've got like a small cap, I've got a mid cap, I've got a large cap, I've potentially got a mega cap, right? That's a whole heap of range, right? And they all offer slightly different risk reward, perspectives. And that makes it really hard. So yeah, that's what I'm just thinking through. And always the idea would be to pick one that you think is at this current point in time offers the best risk reward, sort of, at least for the type of investing I like doing. But yeah, it's pretty challenging. It can be challenging.
I know what it's like to pick favorites, but I'm not going to ask you to do that anyway. Of the other investment advisors in the investing team, who would you say that you are most similar to, and who are you most different based on the stock picks?
Okay. That's a very interesting question. Okay. No, I don't have a problem answering that, actually. So it's interesting. So I think in terms of similarity, like at least in terms of style, where we look for, more sort of the innovative disruptor style investing, where, you're taking a higher risk, but expecting a higher return. Probably similar to Simon Erickson, Steve Symington. They bat in similar areas. We might have, little areas in which we specialize, sort of thing, but, we have pretty common interest in that group, right? And then there are, of course, certain areas where, like, so Simon really understands, for example, the crypto area, right? And I have very little interest in the crypto area, right? So that's an example of difference, like, and I can understand if he picks something related to crypto, it has a crypto bent to it. I'll understand what he's talking about because I understand his philosophy, but it's not something that interests me. That's an example of difference. But yeah, so I'd say Steve, and Steve is, for example, very big on space economy, and I'm genuinely interested in space economy. I think it's really a big deal, but I couldn't, like, if I had to pick stocks in that area, I would find it really difficult. It's just, that somebody specializes in that. So Steve is really, like, passionate, but you have to be passionate about a particular thing, not just be a supporter, but be passionate to understand. So I think those would be similarities, but with the nuanced differences. Then we have got Dana Abramovitz and Max Chatsko. They both look at biotech. So, like, that's wildly different to what I do. I really don't pick biotech. Like, I just find it difficult, and I find it very hard. And, if it is like, mRNA, like, okay, I have to read it up to figure it out. It's really hard for me. So that's really different. Dan Klein picks companies that I'm very generally familiar with, but I wouldn't pick because he picks lower risk companies. That's just not my style. And I guess the style that I think is really interesting is Matt Cochrane's style, because he picks growth at a good price, generally GARP style, growth at a reasonable price, let's call it. If you can call anything reasonable these days, then growth at a reasonable price. His strategy is basically around that. And he picks multi companies. He picks companies which have got, staying power, today's leaders and things like that. And, he'd ask me all the hard questions about my upstarts that are supposed to become tomorrow's leaders. Right? But his style, I can totally understand. And, I can get behind that style because I think that style works really well. If you have a long horizon, that style really works. So I'd say the biotech folks, very different from me, and Dan Klein, very different from me.
You mentioned something before about being passionate about something. I actually did a survey with the Rask team and I asked them to identify where they think their circle of competence is. And I did the test too. And then determine, like, based on our recs, is there an overlap of what we've recommended versus what we all said were, like, we just use gig sectors. So, like, the 10 gig sectors or whatever it is. And we were asked to explain why we chose those sectors. And for me, it's kind of was like an inward looking moment for a second. I thought a lot of the companies, yes, I do have experience in, a technology background and whatever, but it's actually more than that. I think it's actually where I think I'm drawn to companies where I'm much more passionate about. I think the passion is more important than the experience for my circle of competence. And this is the first time I really kind of just thought about that. I always thought, experience, what you're familiar with, that's your circle of competence. But actually, I think it's more what you're passionate about because you're going to go the extra mile. I don't know.
Absolutely. I totally get it. I totally get what you're saying. Like, I mean, and that's the thing, right? And that, and this is variant to what people say, stay within your circle of competence, because you might have, let's say you worked, in your previous life, let's say you worked in retail. But if you're not passionate about retail, but you worked in retail, yes, you have insights. Maybe you're passionate about something else. Maybe you're passionate about AI, and you can actually learn about that stuff, and you'll be really, really good at learning about it. And at some point you'll catch up to, you'll have enough knowledge. So I think that passion thing is really important. And I think passions change over time too, right? At some point, people are passionate about something, then they might be passionate about something else. And that's an opportunity. I think that's really good, because I think we all think that, circle of competence is like, knowledge base and stuff like that, we expand over time. But I just say that anybody can actually expand the circle of competence if you're passionate about it. So I think this model of doing a test and giving people an opportunity to stick to what they're really passionate about is really, really good, because it helps the analyst become just better. Right? Because they just dig better. And occasionally, I think if you think about analyst growth, I think this is, or an individual investor growth, I think this works, is to challenge yourself, right? So for example, I'd occasionally try to challenge myself by looking at biotech stocks. I do look at biotech stocks. I might not recommend them. I even own some, right? But so that's, I challenge myself. Okay, can I, get into that area? And maybe someday I have mustered enough courage and passion to recommend one, right? But I think that's a good place to go, is to try to look at, so there's two different things. You should work on some stuff that's passionate. That's at least what I think. And at the same time, try to push your circle of competence in some other direction as well.
Yeah, I think that's really key too. And I think one of our junior analysts said, I don't really have a circle of competence because I'm only starting out. But so I think if you are starting out as an investor, sometimes it is easy to start in the area that you already are familiar with. So, if the retail is an example, but then maybe challenge yourself, set a 6-month goal. I'm going to learn about this for the next 6 months. And this is, I'm going to learn about e-commerce rather than physical commerce.
Exactly.
And that's where I'm going to spend my 6 months, because I'm more passionate about that. Or next month it's welding. I don't know, whatever you want to learn about, industrials, go and learn about that. And I think what happens in the brain, and this is talking about like the lattice work of mental models, is eventually disparate fields, the multidisciplinary learning, actually do connect. And when you forge those relationships between those different pieces of knowledge, you will actually become more worldly and better understand more topics.
That's why 1 + 1 is not 2, but more than 2.
Yeah, exactly. Yeah, that's an old 3, right? So and it took me a bit of a self-reflection in that test to actually figure out that I should be more directional with where I want to grow as an investor, and less like reacting to kind of boilerplate screens and that type of stuff. Now, where do I want to research? Let that guide me a bit more. And I think that's the exciting part of investing.
I think it's exciting, and it actually gives you an edge in some way, right? I mean, if everybody's screening for the same thing, then you're screening for the same thing, then you can't have an edge. But having, the edge is really the other thing I think is interesting about what you're talking about is if you really like to dive into something, you'd likely have researched enough that you can actually tolerate volatility, right? That's the other part, right? So, I mean, if you're not passionate about something, the first time there's volatility, you're going to leave it, right? So, I really like that. Great thought.
Yeah, that was, and ladies and gentlemen listening, that was just a complete digression. We did not have that in the script.
Not in the script. Just I can vouch for that.
Couple of geniuses just going on a tangent. Okay, so back to reality for a second. So maybe I'll just fill you in with what I've been working on lately. I was supposed to plan this in advance, but I didn't, as it was always the case. We released a new recommendation. We don't we're not as deliberate as you when it comes at Seven Investing, when it comes to releasing recommendations on a specific date, which I really like, actually. Claude Walker previously told me that it can be tough to have an idea every month, as you said, but it forces you to flex that muscle to kind of make a decision. And as we know from studies, the best kind of investment strategy from a personal investor's perspective is just basically to allocate, just to buy. That constant buying is what gets you there. Whereas we release reports, but we don't release it as specific cadence. So we released one this month. It's a technology company. It's growing pretty fast. One clue that I will give away is that its margins aren't as high as you'd expect for a traditional payment for fintech payments business. So really interesting. It's about 40% gross margins or better. So that should give it away. If you want to go and jump into your screeners now, you can. And you can find us on Twitter if you want to guess what it is. You can send me a DM if you want to get confirmation for your pick. But the other thing that we're thinking of working on is something that's even more secret than an investment recommendation, mate. And it's something that, it's something that will require a very special person, I think, to join our team. And normally I'd never, I don't think, put anything into the podcast channels, but I know that our listeners are very talented and very enthusiastic and qualified to become full-time analysts or to simply take a step change in direction with their career. And so I'm just floating the idea out there to see who bites at this potential opportunity within our business, the Rask Group. And I figured, what better place than the podcast? So we're looking for someone that's not a beginner investor, not a beginner analyst, someone with experience, investment experience, and preferably funds management experience. Not necessarily in the directly as an analyst in the space, although you would be hired for our team as an analyst, an investment analyst, probably more at the senior end. We're looking for someone that is interested in studying successful fund managers and then producing content based on that. So looking at what fund managers are doing, researching them, and then producing research for us. And this is where it's very interesting because we're not looking for someone that knows equities research. So we're looking for someone who can study fund managers across all sectors. So things like bonds, credit, equities, global, Australian, long, short, hedge funds, ETFs, LICs, REITs, you name it. If you love that sort of stuff, studying those fund managers, studying the organizations that back them, I want to hear from you because I think our business, and I'm just calling this Project B because I can't give it away on a podcast. If I did give away exactly what was happening, there would be some alarm bells ringing at some of our potential competitors of what we're trying to do. But basically, I think there's a big opportunity in funds management that I'm excited to bring to the market over the next couple of years. And you could be remote, you could be anywhere, and you'll have basically full autonomy over this special project within our business. You probably have a finance degree, maybe even something like the CFA KIA, which is the CAIA, if you see that after people's name, the CMA, CFP, or a Masters of Applied Finance. And ideally, you will have brain control and IQ of 180 or greater, photographic memory, time machine, and all of the above. So, if you want to get in touch, the first challenge is to find out how to get our email, get my email address, use your research skills, send me a report on your favorite fund manager or just even a couple of hundred words. Tell me about it. Send me a CV and we can go from there. Again, you don't have to be based in Melbourne, which is where I am and most of our team is. We have people Patrick's in Sicily at the moment. He spent his week in Sicily working for us. And Lachlan's in Singapore.
Does he permanently live there?
He's actually from Queensland, but his partner's from Milan. So he's actually in Milan. He just went over there not too long ago. And now he's in Sicily for a bit, catching up with some friends and just working for us from over there. Time zones are a little bit challenging, but he doesn't mind it. So you could be anywhere. And that's a great thing. Like you're here in Sydney working for a US-based company, right? Which is pretty cool.
I think what has changed really is the ability now for people to like remote is very different now. It just changes the game. So, basically you've got a global workforce that you can tap into.
Yeah. Yeah. And I think for researchers and analysts, it doesn't really make that big of a difference. I think many people actually have embraced it from the financial services perspective. They don't want necessarily to jump in a suit and go on the train for half an hour into the big office. They're happy to do that a couple of days of the week, but not every day.
Yeah.
So yeah, if you're interested, send me a message, send me an email. Anyway, let's jump into some topics. We had some really interesting ones come through. This was last week, and Sambagini is the Twitter handle, I'm guessing. And it was about a company you said called Strategic Elements, which I'd never heard of. I didn't even think it was a company, to be honest. So I know you took a brief look at this morning. What did you find?
Yeah, so I had a quick look at it, and it's this thing called Pooled Development Fund. This is a special type of, I guess, structure, and I don't know the full details, but I think it has some tax advantages because they are effectively funding R&D. So it's an R&D funding organization, and I guess the way to think of this is that they would do special projects and then maybe spin them out or something, right? This is really tiny. And the other thing I noticed is they've got some projects going with some with defense and some with electric battery charging and things like that. So there's a bunch of different things that are happening. Right now, this is burning cash quite a bit, relatively small balance sheet. So I guess my view of this sort of thing is that it's high risk, high reward, of course. You kind of got to understand what they're doing and so be able to back them to do that. And that's really what it boils down to, right? Because there's not much else to go on right now. That's my view. Interesting sort of projects they've got, but
yeah. So I remember coming across a pool development fund. I can't remember which one it was before, but here I'm just reading on the business.gov.au website. PDFs, pool development funds, will be taxed at 15% of the income and gains derived from equity investments. Shareholders are exempt from tax on the income and gains derived from holding and disposing of the shares. So that's really interesting.
Yeah, I mean, again, you have to make some gains to actually make it worthwhile, right?
Oh, yeah, that's it. You only get taxed on the gains.
You get taxed on gains. And if you have a loss, I guess, I don't know, can you write off the losses? I don't think you can write off the losses if you can't write off the gains, right? If you're not paying taxes on the gain. So there's some tax benefits. I think my rule of thumb, though, is I wouldn't invest in anything just because of the tax benefits.
Yeah, same.
I would invest in it if I believe in it. And then the tax benefit is basically like the cherry on top, right? So not paying tax is great if it's going to work out. So that's my view. I don't have a view on whether this thing is great or not. I mean, I don't know. That would require deeper research than exactly the maybe 5 minutes that I've spent trying to look at it. So it's interesting, but it's too small to be of interest to me.
Yeah, it's very small. And this is actually a point that I want to make, which is why it rang a bell for me, these pooled development funds. Fund managers of a PDF can make eligible investments by acquiring newly issued shares in small and medium enterprises, specific small and medium enterprises, with total assets not more than $50 million. So that 50 million threshold, is kind of the limit there. So there were a few things like, there's been a few things like this over the years in Australia. Another one was a special investor visa. I think it was SIV, which allowed people to come to Australia if they made a certain number amount of investments into Australia.
So the special investment visa thing is there across many countries, where it's basically a way of encouraging capital inflow. Some countries, I don't know what the Australian limit was, but some countries would set that at like something as low as like, a couple $1 million, right? You bring in a couple $1 million and you invest it in real estate, and that is considered enough. Right. So it's a capital inflow. If you get enough number of people to do it, you get a lot of capital inflow happening.
Yeah. Yeah. So interesting company there from Sambagini. If you know anything, mate, and you want to tell us, feel free to reply in Twitter and let us know a bit more there. It's a little bit outside both of our wheelhouses, or just at least our range for what we usually research. There was another question that came in from, or talking point that came in from Glenn on Twitter. He said, "What are your thoughts on the A2 Milk annual results?" So this is an interesting one. What do you do? We want to? Should I share my screen? You share your screen.
I can share my screen. All right. Yeah, I can. You want to start? Maybe you can start. I can go later.
Yeah,
if
sure.
There's anything, if there's anything else to add.
Okay, here we go. For those of you that are watching on YouTube, here we go. I always get a little bit nervous. I don't know which Chrome I'm talking about. I think let's just go with this one to start with. So, you know what, mate? I can't because I'm on a new iMac and I can't share my screen. So
excellent. And I was going to suggest, I was going to give you a hot tip. I never actually try to share anything off my browser, which I, of course, don't use Chrome, which is, if you're on a Mac, you should be using the Safari. But I always have a PDF open on preview. And that's what I would share. So let me now not make a fool of myself. And let me see if I can get that. I think
this new iMac, I tell you what, I feel like the Apple Lords are against me.
Wow, what's it doing to you?
Well, it's. I feel like it's slower than my old iMac with Chrome, but I feel like it's telling me something about Chrome.
Yeah, the Chrome probably is a bloated software. You just have to get rid of it. That's it. I mean, Chrome it consumes a lot more. Run the utility tool and just check the memory consumption of Chrome. It's huge.
Okay, I'll take you up on that.
So here's the results. Revenue down a huge 30%. To 1.2 billion. I'm really sad about this because this company was one of the poster childs, I thought, of companies listed on the ASX that had growth at scale. I'm kind of devastated by that. I had actually a tweet out about growth at scale, how they're growing at 30% plus for a long time, now into the billions, right? But they're down 30%. The other thing I'll point out is that look how, when the revenues, and we know why the revenue is down, right? Because revenue is down because suitcase trade, or let's not even call it suitcase trade, because the organized Daigou is also down. That's having an impact on the channels. They don't have direct channel distribution as they have. Okay, so they have mother and baby store presence, but it's, the huge margins were being made off stuff that was being, essentially distributed by the Daigous, right? So, the revenue being down has a huge impact, but the other thing with these sort of businesses is just the operating leverage, right? The operating leverage works beautifully on the upside and works negatively on the downside as well, right? So the operating earnings or EBITDA was down 77%, right? So revenue was down 30% and operating earnings were down 77%. The EBITDA margin was only 10%. Net profit after tax was also down a huge amount. So nothing pretty here. And there was a number of downgrades that they had over time. So again, they're saying that there's some improvements happening in channel dynamics, but one has to wonder at this point as to how much permanent damage that has happened, because like you had a channel that was being used, there was then oversupply into that channel that meant some discounting. How much damage has happened to the brand name? It's a question to ask. And the other thing to think about is how much of the sales were push versus pull, I guess, right? A true brand has pull versus, if you're really using push to sell things, then it has an impact. So these are things, again, I don't have a good answer. I'm really saddened by this, but the valuation, again, because of this has, the shares have basically catered completely. And I still feel like this is a takeout candidate, again, a good brand.
Your bet is looking a lot better than mine. Obviously, for those of you who are new listeners to the podcast, there was a bet made. I said Treasury Wine Estates is a better takeover candidate. And you said A2 Milk. And it's been a tale of two companies since then. What Treasury Wine has continued steadily upwards, and A2 Milk has, as you said, cratered. So that may make it more appealing. And I guess one of the concerns that people have is we're just seeing a doppelganger of Bellamy's all over again here with A2 Milk. But I think there's some subtleties that need to be pointed out. The first of which is that A2 Milk actually has a pretty big milk business. It's not just infant formula. So keep that in mind too. So there are some assets that are valuable. But at the same time, I think to your point about push or pull, but also just to the distribution channel in general, it's really important to understand that maybe a lot of those China sales from before the pandemic the Australian sales weren't actually Australian sales. They were Australian sales, which were then sent overseas. So through that suitcase channel. And so the suitcase trade, as you mentioned. And so if you're valuing this business on the basis of historical results, you've got to be really careful and also got to judge when the inventory cycle kind of catches back up and it comes back into balance. Because if you get that wrong, there can be a lot of write-downs and a lot of cash going out the door from here on out. The one thing that I will mention is that they do have a US business and distribution, but it's still very small. And the other thing is that the company, just eyeballing last year's cash flow statement or the year just gone, it actually is free cash flow positive. So even in a really bad year, they said next year, the year coming looks like it's going to be bad too, but it was still free cash flow positive. If it can maintain that, then maybe there's end in sight. If it can maintain a really bad couple of years, who knows, maybe it is one of those turnaround plays. But Warren Buffett's words of turnarounds seldom turn kind of ring loud and true. There was actually something that I did want to share with everyone today, which I can't share because my screen's not working. But basically was that if you look at all the companies and we've made this point before, if you look at all the companies that surround A2 Milk, there are a lot of strong competitive forces around A2 Milk, whether that's, the CCP, the Chinese Communist Party, having, state-run enterprises that determine regulatory environments for like Chinese label versus English label and where you can sell and what you can sell and mainland versus Hong Kong and all that stuff. That's one big, big beast. And then you've got things like supply and distribution coming from Australia, geopolitical tensions between these countries. There is a lot for a single investor to wrap your head around and try and determine where all those pieces are moving. And at the center of all of this network, you have A2 Milk. And what A2 Milk is a capital light business with a wonderful brand. I still buy A2 Milk religiously. But at the end of the day, it's only as strong as its ability to operate. So if people aren't paying the premium for that, meanwhile, Chinese companies are getting ahead from Chinese developed infant formula, it's pretty tough. It's pretty tough. That's all I'll say. Not a business that I'm interested in buying because the visibility on earnings is too hard for me. That's me being negative. And I'm not a short seller. So maybe me being negative, I don't have a lot of clout in that regard. But in terms of our next few topics, we thought we'd spend a bit of time just going through some of our top reports from reporting season. And we've got 5 companies in total. We've got 3 US actually, and 2 ASX. All of them, though, do a lot of their business outside of Australia. So they're basically all global in some sense. Maybe I'll go first because there's an odd number, and I'll pick Redbubble. So we talked about Redbubble before. I've talked about it a lot lately. It was on the Twitterati, pretty anti. If I could get a poll of the Twitterati, I would say that they're quite negative on Redbubble. A lot of people see it as a business that is basically a glorified retailer, which I can understand if you don't really understand it that well. So what does Redbubble do? It's a global marketplace. It's different to Etsy because Etsy is basically just a marketplace, whereas Redbubble is also a fulfiller. So for example, one of the things that, this is news to you, one of the things that we're going to do at Rask with our brand is we're going to just upload our designs for all of our, our logos, our websites, our education, podcasts, all that stuff. We're going to upload it to our own Redbubble page. And what that means, we're not doing that for money. Basically what it means is if you want to get a Rask inspired t-shirt, or if we have events where we give things away, or notebooks or pencils or iPhone cases, you can do that through Redbubble. And us as artists, air quotes artists for those of you that aren't watching, you can get a Rask inspired mug to sit on your desk. And there's, from the artist perspective, there's actually no incremental effort required. So that's the beauty of Redbubble's business models. Once you are an independent artist and you put your designs on there, there's just, I don't know if you call it free carry, but there's basically just customers coming in and buying the product, and they're fulfilled by a manufacturer somewhere else. One of the big concerns about Redbubble coming to these results was that it's a one-trick pony in COVID. Yes, there is a big element of cyclicality, but also how much of the demand from last year is just going to carry forward into this year. The second half was much weaker than the first half, but you have that with Redbubble anyway because the Christmas period is its busiest period. Company is free cash flow positive, although don't expect it to get back to what it was before COVID because it may take time to lap that. Like the lapping of that might actually be negative before it's positive again. It might just take 1 to 2 years. Artist retention is really high because, like I said, there's no incremental effort, so there's no cost with keeping your designs there. The other concern was that there's a lot of patent infringement, and copyright infringement, I should say. Many of these online marketplaces, whether it's Facebook, Etsy, all of them, Amazon, deal with fakes, deal with things that aren't legit. The difference with Redbubble is that it actually has a fulfiller network, so that introduces some different legal complexities in the state of California. So management seem to be on top of that. Management, in my opinion, are very high quality for an Australian technology business, and it's a very high risk business, but I'm happy to own shares. And quite happy to own it to see where it goes over the next 5 years. It's a very high risk business. That's all. That's how I'll conclude.
Yeah, and I think the interesting thing there is, while they have the fulfiller network, right, but it really doesn't cost them as such that much, right? It's just their ability to, it's basically a three-sided network. Basically, they've got the fulfillers there to fulfill things, but it's a retailer that has no inventory, right? It's the inventory-less retailer. So it's not really a retailer in that sense. It's basically a marketplace, effectively. So yeah, interesting. And you're on the wrong side of the Twitterati on this one. So enough number of people to keep you. And my dog is trying to get into
the office.
break the office or do something. It's not being nice. Okay, what's the next one on the list?
The next one is a company from you, which is a cybersecurity business, which we talked about 2 weeks ago, I think. Goes by the ticket code CRWD, if you know it.
Yes, CrowdStrike. So so this time what we did, we're talking about these companies that we have actually talked about before, but we're just sort of, I guess highlighting results we really liked. And CrowdStrike, I think, had fantastic results. So CrowdStrike's business, just to explain it very simply, is it's the new gen. This is the simplified version. Is the new gen virus detector, right? And unlike in the olden days where you got signatures every so often that was downloaded to your computer, this doesn't do that. This is basically on the fly dynamic. Runs a lightweight agent on your end, any device. Could be a Mac, could be a PC, could be a smartphone, if it's an iPhone or something like that, and it basically then talks to the cloud, sees what other people are seeing, and basically blocks threats, right? And it's blocking threats at what they would call the endpoint. It's protecting the endpoint. So it's an endpoint protection system. Always learns dynamically, and as more and more people use it, it has a wider and wider, basically, a footprint for measurement and detection, right? And well, that's not nice. And my daughter is not doing a good job. Let's put that on the record here as well, for other people to know that she is supposed to take care of it and make sure that he doesn't bang on the door. But ARR growth was 70% to $1 billion. That is pretty fantastic. This very high retention business with a very long runway for growth. So yeah.
What would you say? If I was looking at it today, what would be the one kind of metric that I should focus on, or one factor?
So I look at two things. I look at the growth rate. So, it's a high valuation stock, so you want the growth rate to be high. And the other thing that I really like for this sort of SaaS businesses is to sort of think about the a dollar-based net retention rate. So this is where you want to look at, how much revenue that they are retaining from the existing clients. Those are two things that I would say you need to keep an eye on.
Yep. Okay. My turn now, and I'll go with a company that's also a US business, which is Salesforce. We talked about this a few weeks back. Many people know Salesforce not only because it's at the center of almost every digital first organization in terms of capturing customer data from its legacy CRM business, which is also very innovative. I say legacy, some people means that it's not innovative. It is. And we actually recommended this company quite a while ago, but revenue up 23%, operating margin increased by 1.7% to 5.2%, but don't let that fool you. On a non-GAAP basis, it was 20.4%. Operating cash flow up 10% on a year-on-year basis to about 390 million, I think. Interestingly, what we said in our initial write-up seems to be playing out. So Salesforce's original software stack was around basically the sales CRM. So interfacing with clients, you add their data into the system, and then you use that to facilitate sales. Now they've got these other divisions known as service, platforms, and marketing or commerce. And each of these businesses are over $1 billion in revenue. So they're all, as Mark Benioff would say, they're all unicorns. But then you add in the $37 billion Slack acquisition, which was at the time kind of, I guess the headline wasn't very positive. And what we saw was that they paid $37 billion, but now it is the fifth unicorn, earning over $1 billion in revenue for the business. And I might give everyone a quick example of how they all come together. So they have a business called MuleSoft, which sits within the platform and analytics division of Salesforce. But this Chief Product Officer, Brett Taylor, on the investor call said, MuleSoft helps customers build the application programming interface, or the API. Tableau will help them visualize the data that's extracted, and Slack, which is the most recent acquisition, enables Salesforce customers to act on this data through notifications. So what this is basically doing is Slack has complemented everything that they're already doing around data management, around customer management, around servicing clients, and around building things. And I just think it's a really interesting business. And it's one of those businesses that seems to it's just clockwork. Every quarter, they serve up results. Yep, no worries. Mid to high teens in terms of revenue growth and stable gross margins. It just kind of just one foot after the other, just keeps going. So Salesforce, really interesting business. We've got two more. The second last, which may not be second from last in the order of I guess, quality, which is a company called MongoDB, MDB. Over to you, man.
Right. Okay. So I really like MongoDB as a company because I like the idea of, so what they're doing is a very simple thing. So, databases historically have been what it's called a relational database. So basically you have rows and columns and you search basically using a key. But rows and columns by definition effectively means that you need a fixed number of rows and a fixed number of columns, and that's very structured. But not everything in the world is very structured. So, a great example would be you want to store information about, say, patients or customers. Somebody has a middle name. Somebody doesn't have a middle name. Somebody has a long address. Somebody has a short address. Somebody gives you some information. Somebody doesn't give you some information. So, you can, of course, always generalize this to a row column format by having n number of, rows and n number of columns and having every possible column in. But by default, if you could make this really simple by just having those columns that you needed, and data becomes a bit unstructured, right? And that's basically a type of database that is enabled by MongoDB, right? And they have, they're not really I would not say that they're the first ones to do it. They're actually not the first ones to do it, but they're the ones to popularize it. Because the project started as an open source project, and then they're a great example of how you can take open source ideas, build a community around it, then build a company around that. I guess the previous great example of that would be something similar would be Red Hat, right? Which is basically Linux, but providing services of Linux, right? So, and Linux is open source. So these guys basically have two versions of the software, and which one is the Enterprise Advanced, and the other is basically a completely cloud version called Atlas, which is basically offered as a database as a service. So it is a service that you can instantiate and on the cloud, on any cloud provider, and run it. And you can basically have a multi-cloud deployment if necessary. And I think so. The enterprise. So most people who used it originally were using the Enterprise Advanced, and then they basically brought in the database as a service offering called Atlas, and then slowly but steadily made the two they arrived at feature parity, right? And as soon as that sort of started happening, Atlas really took over. So this is basically an idea that has taken many years to develop, right? So the community, got behind it. Then a lot of people got trained on it. Then a lot of developers actually built software on it. Now we're at that stage where complex database, applications that require a database at the back end. So most applications have a database at the back end, right? So people are willing to run mission critical applications now on MongoDB, right? So the company's growth, not, if I just look at the numbers, right, it'll look like, well, numbers are not that big. Well, they're pretty big, but not that big if you think about it from a US standard. Revenue was just under $1 million under 200 million for the quarter, up 44%. So not, it's fast, but not super fast. But here's the big deal. Big deal is that Atlas grew at 83%. And it accounted for 56% of the total revenue in the second quarter of 2022, which was the reporting period that they've just reported. So basically, you can think of this business as two components. So they're now guiding for somewhere around 800 million for the year, which you can sort of annualize that, the 200 times 4. But 56% of this is actually coming from Atlas, and Atlas is growing at about 80%. 83%. So you have a $500 million business, basically, effectively, close to $500 million run rate business that's growing at 83%. And they're adding customers like anything, and they're sort of going up in the hierarchy in terms of where mission critical applications are going to run. So this is still free cash flow negative, but I really think this is the type of business that can win for a really long time. And sometimes you say imitation is the best form of flattery, right? So everyone tried to copy this, because again, remember, it's open source, right? So the basic foundation is open source. So there's nothing that stops Microsoft from basically taking the open source and then trying to do their own version, right? Well, they tried. And then I think there was Amazon that tried the same thing. And I remember in the early days, when Amazon announced this thing, the stock fell, and then I told people that, hey, look, it's okay. Microsoft has tried this in the past and it didn't really work. What makes you think that it's going to work if Amazon tries it? And it didn't really, now all of them partner with MongoDB. So yes, they still have their offerings, but, MongoDB just keeps chugging along, and it's basically seeming like they're winning the database as a service side. So big market.
Can I just ask one question?
Yes.
So I'm in the process of currently trying to build a cloud database, basically, that I can get from anywhere in the world. So I could ping it with an API and retrieve my data. So I should know the answer to this question, therefore, but why would I say choose something like MongoDB over GCP, Google Cloud?
Yes, so it depends. If you want to run a SQL type server, you can run it on anything. Yeah. Right? This is what's called a NoSQL. So basically, it doesn't require a SQL-like query, and you can query for anything really. That's the unstructured data. So basically, if you are developing certain types of applications, it just gives you more flex to do it, right? So you could use any other cloud version of software, but you could also use MongoDB, right? And maybe MongoDB is not necessarily the right software for you. That would be my answer, really. It's not very satisfactory, but
yeah, no, that makes sense. Okay, cool. I like it, MongoDB, and pretty sure the stock price has gone straight up recently. So
yeah, the stock went on earnings went up like some 26% because the earnings were really like, I think, okay, so I'll clarify. It went up a lot on earnings. And people basically looked at it and said, okay, in Q1 it grew like this, and then there's acceleration. So it's like had 2 quarters straight back to back of acceleration. I don't read too much into that because A, it's 2 quarters, and B, I think there's certain things with how the Enterprise Advance gets recognized. So there's revenue recognition for the Enterprise Advance is not really it's not really pay as you go, right? So the Atlas is pay as you go. You pay for what you use, whereas Enterprise Advance you sign a deal. It's a contract, right? So the bigger the contract, the more you can upfront recognize, because that's how the 606 accounting rule works. So there's those impacts, and then there's of course lapping the pandemic and things like that. So I'm not reading too much into that, but yeah, but I think people got a little excited about the fact that there's acceleration, and then Atlas is really seemingly sort of becoming different. I guess to answer your question, why wouldn't you use GCP? So a lot of companies, this is another thing that the company talks about. A lot of people don't want to have all their eggs in one basket, right? So people would prefer, many companies would prefer not having mission critical stuff with one vendor. So you'd want to have a multi-vendor strategy because cloud does go down. So if you want to have a multi-vendor strategy and have resilience, then having a independent provider that can actually give you the multi-vendor strategy is better.
Okay, makes sense. Last 5 years, it's up 1,500%. So
been a good stock.
A good stock.
It's been a good stock.
I remember looking at it in March last year during the sell-off when it was about $115, $120 a share. Now it's $490. Joke's on me yet again.
I bought around $40 this stock. Wow. So this has been one of those. Yeah, this has been one of those fantastic stocks. And I've been talking about it since I bought it. Like I said, okay, everybody should buy this stock. Nobody believes me. Just buy this one, And people say, this name is funny. It's like, why would you call anything Mongo? Mongo means big. It's like, it's like a pun. But yeah, this been it's an interesting, it's got lots of interesting things, but yeah.
Cool. Like it. That's MDB, ticker code. It's on the NASDAQ. So the final one from me, which will be a bit more, I guess, concise coming into the finish line, which is MDB. Not MDB. What am I saying? EML. It's EML Payments. Talk about concise. EML Payments is the Australian payments business we've talked about previously. Like Redbubble at the top, EML was a very hotly debated company a few months ago when it fell 42% in a single day on the back of releasing a kind of shallow update when it said that the Central Bank of Ireland is investigating its PFS acquisition or its subsidiary. I say acquisition because it made the deal just before COVID, renegotiated it during COVID, and the business then was revalued down again thanks to all these charges and thanks to some other things. I think it was related to breakage. But EML is basically a fintech enabler, so enables companies to take payments, whether those are in Europe at the moment, account to account, which is really interesting, or here in Australia, if you have, say, like a card that you get for like a cash rewards card, or if you get something like a card that's issued by like a betting group, like if you're into punting, something like that. So they can kind of help anyone in almost any way with that, and they run on the traditional rails. So the business
they do some other things too, like so they do this meal entertainment cards as well, which the healthcare sector here in New South Wales actually uses them.
Yeah. So, and they basically dominate that in Australia. So I can't remember the exact figure off the top of my head, but they're basically the game in town now that some of the big banks have left that space. So if you're in the healthcare profession, you'd probably be familiar with EML, at least some of what it does. So it's got prepaid cards, reloadable cards. It's got virtual accounts. It's got account-to-account payments, all different types of things to help you manage either your enterprise or if you're a startup, kind of enable you. And the business fell 45% in a single day not too long ago, so it's great to see it coming back to parity, at least from that point in time. The business grew very strongly in the double digits, as I articulated on a previous podcast episode, but organically it was still positive, which is really important too. recently made the acquisition of Centennial, again in Europe, to bring those account-to-accounts transaction closer and faster and more seamless for its users. I guess the big thing for EML is that they've provisioned for the CBI in terms of an impairment. They're working with the regulator. They actually made a decision when they bought, well, not them, but the prior vendors actually made a decision to get licensed in Ireland following Brexit, which kind of, for one reason or another, you could say that that's good or bad, but in this instance, it seems to be like something that you want to be mindful of. The regulations in Ireland may be a bit different to what they are in, say, London prior to Brexit, so it changes the business model a bit. But all in all, management have kind of stuck to their guns. They've provisioned for it. They've said it's going to, make things a little bit more costly in terms of our compliance. But I think from memory, it doesn't seem to be anything related to fraud or anything in that respect, which is pretty common in these types of businesses, I've got to admit. So maybe there is a fine coming, although they have provision for legal expenses. All in all, I thought the result was pretty strong, and I think EML is going to continue doing what it's doing. It's a pretty hard business to wrap your head around, if I'm honest. They're making a lot of acquisitions, so visibility on organic earnings. Like people, even analysts tend to make this mistake, in my opinion. They exclude the most recent year's acquisition and then assume everything else is organic. But that, if they made an acquisition the year before, or the year before that, is that organic? Like how far back do you go? And they'll tell you it's organic because it falls into a different reporting period. But you've got to be mindful of what is actually their core competency and are they sticking to that as they roll up other businesses? I think EML is. It's led by Tom Cregan, CEO we interviewed previously. So I think it's a good business. Again, really high risk, but just watch the margins, watch the payment volume, and any future provisions for that CBI investigation. And that's EML. That's a wrap. ASX EML.
I was going to say a couple of things on this one. So
Sure.
One interesting thing I think is sometimes, you get good returns on higher risk opportunities, right? So, things get discounted because people are scared. If you have an edge there, I think that's an advantage, right? And I guess if you make enough number of those bets, it can actually work out for you. That's number one. Number two is, I think EML's big thing, as you said, you just rightly pointed out, right, is acquisitions, right? So it's really hard to tell what is what. But there's one thing that we can tell, right, which is, how much is on a per share basis the earnings growing. So, companies like to report their EBITDA numbers because that doesn't adjust for number of shares. But I think what we should look at really is on an adjusted basis for the dilution that comes through these acquisitions, how are they growing? And I think in the past, they've done well. I'll caveat one thing is as a company becomes bigger and bigger and bigger, and I'll give them another credit, which is that renegotiating that PFS deal was really smart.
Yeah.
that was really smart.
Yeah.
That was big. So again, that basically suggests good management skills, right? I mean, renegotiating a deal, and that seems that the other party is also amenable to that deal. That is really, I think, something. And the only yellow flag I'll throw out is as the company becomes bigger, the acquisitions become harder. Right? Because if you are growing by acquisitions and your underlying organic growth is low, and you're fueling it by acquisitions, well, once you're a $1 billion company, you need to make $300-400 million acquisition to actually drive growth, right? And it becomes harder and harder and harder and harder as you move up the chain. So something to be mindful of and think about is, and sometimes you can make an acquisition that actually fundamentally alters and changes your business for good. And if that happens, that's great, right? So yeah, this is a tough business. I've looked at it a number of times. I used to follow it quite closely at a point in time. And I actually quite like the business and I like the CEO and I like his straight shooting way of talking. Those are things I really like, He's not trying to pander. It's like, well, this is what it is. Like it or leave it.
And he spends the extra time on calls. I think it was 2 hours the other day on the investor call. So he wants to answer all the questions. So yeah, I guess you can always just reach out to them and ask questions, which is great to know. That brings us to the end. So we've talked about a few different companies. We talked about MongoDB, EML Payments, Salesforce, CrowdStrike, Redbubble. We even dived into A2 Milk. And I thought coming into this, we were going to be flawless, absolutely seamless with sharing our screens. But lo and behold, Apple's privacy, I mean, who cares about privacy? It's all an illusion anyway. Didn't let me share my screen. So you did instead. Thank you for that, sir. We talked about strategic elements in brief, which is a PDF and not something that you get from Adobe. It is a pooled development fund listed on the ASX. We talked about, oh yes, we're hiring at Rask. So go back and listen to that section if you want to learn more about that. We also talked about how Anirban is different to everyone in the 7 investing team and how they all bring unique strengths to stock picking every month. So mate, if people wanted to find out what you're researching, get your latest pick, which I did read, and I was, let me just say, very, very good pick, sir. And you took a risk with this one in terms of the timing, but I liked it.
It didn't work out negatively, at least. While it didn't work out positively, it didn't work out negatively. So I was happy with that. I think this one will work out well over the long term. This is less risky versus my usual picks. But I think this is a good one. Yeah.
Well, I own shares in it, so it better be good.
Well, there we go. That makes the 2 of us, and at least we know, yeah. I'm not, I'd say that we might have some friends who also own shares in them.
Yes, so, it sounds like it.
Yeah. So, I think it's a great business. I think, and yeah. So if people are interested, then you go to 7investing.com/subscribe. Use the Rask code RASK. Yeah, you get $10 off the first month. You don't have to subscribe if you're not active in the US market. You can listen to us. But if you're active in the US market, I think we bring good value for what we do. Absolutely. Lots of stuff. Otherwise, you have us to listen to. Otherwise, you should just subscribe to Rask. Yeah,
if you're interested in ASX stuff, you can join Rask at rask.com.au. And always just find us on Twitter. I'll share that actual screenshot, which I tried to share on Twitter. So you'll be able to find us both there and ask any questions that you have. Mate, always a pleasure to chat.
Same here. Chat next week.